Hey, what's up, everybody? This is Courtney Golden with the Flex Financial Trading Group. Just checking in with you real quick. Just want to do a quick video. For those that have been in tune with the market this week, you've probably been hearing a lot about IPOs. Today we had Airbnb have their IPO. And then yesterday we had Door Dash that had their IPOs. And for those that don't know what an IPO is, that stands for an initial public offering. And what that is basically where private companies go public and they allow their company stock shares to be traded, bought, sold, traded by the general public. So average retail investors like you and myself, we get a chance to take part in that company, buy and sell those shares if we choose to do so. And that's a great thing for a company. It's a great way to raise capital for a company, raise money, so that way they can use that for their business operations. They can use that money to grow and expand their businesses. So that's IPOs are a great thing for a company. But they're not always necessarily a good thing for the average retail investors like you and I. And there's a few reasons I say that, and a few reasons I recommend that you stay clear of IPOs. And one of the first reasons is because with the IPO price, there's a set price of the IPO, and then there's the actual price of the IPO when those shares actually go public and live for the public to be able to trade those shares. So the set price of the IPO a lot of times is much, much lower than the actual public price that we get. And that set price is really reserved for the private investors and some of the high investors that have access to the set price before we do. So an example of that is today with Airbnb, their set price of the IPO was actually $68. And all the private investors, all the high-end investors, they got access to that stock before we did. By the time it got to the general public, where those shares went live for us to trade, the stock price was already at $146 per share. So that's quite a big difference. So we're already starting off to an advantage because we didn't get to take part in that set price, which was much, much lower than the price we got. The second reason I recommend staying clear of IPOs is because the IPOs don't really have a history of performance in the stock market. So one of the key advantages that we have as investors and traders in the stock market is being able to look at the past performance of companies and of stocks and use that information to our advantage to figure out if and when we want to put our money into that particular company or that particular stock. So we can look back at the history of that stock and see how it performed over time. And we can figure out if we want to go ahead and put our money there. With an IPO, we don't have that advantage because it's an initial public offering. There's no real history. We don't know how Wall Street's really going to react to that stock. So you're kind of getting in the beginning stages and you're feeling like you're doing a good thing, but you don't really know which direction that stock is headed and how Wall Street is going to perceive that stock. So that's really a disadvantage for you when you're initially putting your money into an IPO. And then the last thing about an IPO is a lot of retail investors don't realize there's something called a lockup period with an IPO. This is where those private investors and those people, investors that got to take part in the set initial public offering price, which is the much, much lower price. This is where they have the ability to sell out of those shares that they bought at that much, much lower price. The lockup period is typically it's about 180 days. So after about 180 days, those private investors, those higher end investors that got in at that much, much lower price, they can go ahead and choose to sell out of that stock. What happens then is if you get a bunch of investors selling out of that stock, taking advantage and taking profit after 180 days, that can drive the price of the stock down and cause a big sell-off and cause that stock price to drop. And what happens is for us as retail investors that got in at the live public offering price, which is much higher, we end up holding the bag for that. And we end up having to wait for that stock to go back up, retrace, and just for us to break even or give us a chance to get some profit. So after the lockup period, you got to be real conscious of that those private investors, they can sell out of that stock at that point and start to take their profits, and you can get left holding the bag. So that's a few reasons, again, that we like to stay clear of IPOs, and we like to teach our members at Flex Financial Trading Group to do the same. Not to say that companies that go with IPOs are bad, or that have IPOs are bad companies, but there's just not enough history within the companies, and you just have to be aware of some of the nuances that come with IPOs that as a smart investor or trader. So just wanted to kind of cover those points with you guys. Hopefully that'll help some of you guys out there. If you need a little bit of guidance with your trading and your investing in the stock market, we have a great program with you at with Flex Financial Trading Group. Check us out at flexfinancialtg.com. We can show you our low-risk stock and option strategies to help you generate weekly and monthly income in the stock market, gain some consistent profits, and help you also build your residual income by showing you how to build your dividend portfolio. So check us out, flexfinancialtg.com. Our FlexU program is a great program. We'll get you started and pointed in the right direction in the stock market. That's it for me, and we'll see you next time. Peace.